Dear viewers, today I am going to introduce you to the world of ETFs. ETFs stands for Exchange Traded Funds. Who doesn't know about ETFs? Everybody is talking about ETFs today. In this episode, you will get a chance to know everything about ETFs, how they work, and is it worthwhile for you to have ETF in your portfolio. Watch this episode till the end to get every bit of information you need about the ETFs. This is NRI Money Clinic for you, and I am Dr. Chandrakant Bhatt, investment consultant and a financial planner.
NRI Money Clinic. No hype, just the right advice.
Dear viewers, first let us try to understand what ETFs are. Now you know about the stocks, the individual stocks. You also know about the mutual funds. What if I say that there is something in between these two? They resemble like mutual funds, but they trade like stocks. So they have a dynamic pricing. You can buy and sell them on an exchange. That's precisely the exchange traded funds. They work like mutual funds. They resemble exactly like mutual funds. Whereas the buying and selling happens like a stock. That's an exchange traded funds. What is its importance? What is that thing you should be knowing? The key points of the ETFs. Let's look at all of them one by one now. Here are some of the key points to understand the ETFs. Now, in case of a stock or a bond, it is an individual security. Whereas an ETF is a pool of assets. It can have multiple stocks, it can have multiple bonds, or it can have multiple things under an ETF. It resembles like that of a mutual fund. How does a mutual fund is constructed? It has many assets into it. So it resembles like a mutual fund. But the difference comes here that the mutual funds cannot be traded. You have to buy a mutual fund from the mutual fund house. Whereas in case of an exchange traded fund, these are the pooled assets and they can be freely traded on a stock exchange just like any other stocks. The best part of ETFs is they come with a very low cost structure. Like stocks, their prices are very dynamic. During the day when the trading is taking place, their prices can move up, their prices can come down. You can use an ETFs even to trade. You can buy and sell them as an intraday, or you can take positions. You can do whatever you want. Just like whatever you do with a share, a similar thing you can do it as an ETF. With mutual funds, you don't have that luxury. You have to buy mutual funds at the NAVs which gets declared at the end of the day. Are ETFs popular across the globe? The answer to this is yes. ETFs came into investing world a couple of decades before. They slowly started gaining ground in the year 2000 to 2010 period, but right now their popularity is growing by the day. By 2021, the assets held by exchange traded funds crossed literally $10 trillion. An estimate says the total number of ETFs which are available across the globe today is in the range of about 10,000 ETFs. Yes, it is 10,000 ETFs or so are available across the globe today. What about the story in India? The ETFs are very popular across the globe. Internationally, the investing world just cannot think about a world without ETF. Whereas in case of India, ETFs have just gained entry. They were there before, but they were not that popular. Now slowly, different companies are introducing ETFs and the popularity of ETFs is growing even in India. Most of the ETFs which are there in India today are passive ETFs. That means either they track an index or they are tracking some commodities like gold or could be an oil. But in India, ETFs are in its infancy. It is yet to gain popularity. The volumes of trading in ETFs is low compared to the volumes that are there in the stocks. Whereas internationally, ETFs are showing real good volumes for people to participate in this investment exercise. The crucial question is, how can you use ETFs, or for what purpose you should use the ETFs? You should know the purpose for which you are using an ETF. Interestingly enough, ETFs can be used for any purpose. ETFs can be created out of anything that you want. So it can be created out of commodities, it can be created out of the stocks, it can be created out of the index, it can be created out of the sectors, it can be created out of anything. ETFs can be created. So what are the purpose it can serve? You can buy ETFs to create an income. You can buy an ETF for the purpose of trading or for the purpose of speculation. You can buy an ETF and hold it for the sake of capital appreciation. You can buy and hold an ETF for the sake of leveraging the assets. You can buy and hold an ETF for the purpose of hedging. So you can use ETFs for any particular purpose. So there are different types of ETFs which are available, which you can use it for whichever the purpose you are buying them. Now let us look at what are the types of ETFs which are available. The most popular variety of ETF which is gaining ground or becoming popular are the passive ETFs, or these are the ETFs where there is no fund manager. So they are introduced into the market with certain underlyings. So they have some stocks or commodities or bonds or any of these things, and they don't change with time. So these are called the passive ETFs. These are very, very popular. Most of the passive ETFs will track an underlying index. It could be an S&P 500, it could be a Nifty, it could be a sector index, it could be an IT index, it could be anything. So the passive ETFs generally track a different index. Contrast to the passive ETFs, you also have an active ETF. What's the difference between an active ETF and a passive ETF? In case of passive ETF, there are no fund managers. ETF at the time of launching has certain things which are packed into this security, and that wouldn't change. Whereas in case of an active ETF, there is a fund manager and the underlyings could be changing in the ETF. Compared to the low cost of passive ETFs, the active ETFs could be expensive like a mutual funds. So you need to be choosing what is that thing which is suitable to you, a passive ETF or an active ETF, or for what purpose you are buying them. I told you that there are thousands of ETFs which are available for you to choose from and invest. Can we categorize them? How these ETFs have been categorized, or how these ETFs have been manufactured? What are the things that they are representing? If I look at the broad categories of ETFs which are available for people to invest, you can see multiple categories in them. You can have ETFs around the index. You can have ETFs as a bundle of different stocks. You can have an ETF of bonds. You can have ETF of real estate. You can have ETFs of leveraged instruments. You can have instruments of commodities. In fact, practically you can create ETFs from any kind of a asset or any kind of an idea that you might have. It's possible to create an ETF. So ETFs, there are hundreds of categories. I have told you these are the broad categories under which you can see different ETFs which are available for you to invest and choose from. Now, if you decide to buy an ETF, how can you go and buy an ETF? Let's look at how you can buy an ETF. To buy an ETF, the same arrangement as buying a stock, whatever you do, that arrangement is required. Either you should have an account in a brokerage house, or you should be on one of the investment platforms. Most of the investment platforms or the brokerage houses will give you an access to the different ETFs which are available for you to choose from. So the first thing is have an investment account either through a brokerage house or through an investment platform. Then you are ready to invest in an ETF. What else should you do? You should be doing your due diligence. You should be knowing what you are buying. You should be knowing why you are buying. You should be knowing how long you want to hold it. What is the purpose behind buying that an ETF? Whatever the research you do around buying a mutual fund or a stock, the same kind of work has to be done when you are buying an ETF. But to buy an ETF, all that you require is an investment account on a platform. Dear viewers, by the way, if you want to get the benefits of ETF, if you want to buy ETFs, or if you want to create a portfolio of ETFs, you can make best use of our services as well. If you are interested, please send us a WhatsApp message on the number shown here on the screen, or we have given a form below here in the description box. Fill in your details and send it to us. One of our team members will contact you and will help you to invest either on your own or with the help of professional advisors to create a portfolio of ETFs. If you are living in Middle East, if you are living in African countries, if you are living in most part of the world, we have a jurisdiction to help you in setting up your ETFs portfolios. Nevertheless, I would like to say in some of the countries we may not have a jurisdiction to help you with, but once you send us the details, then we can check whether we are in a position to help you or not. Please send a message now in case if you are interested. Now, while buying the ETFs, I said that you have to do due diligence. What are the things that you have to consider while you do your due diligence? The first point that you have to make sure is ETFs will come in a fancy name. There are codes with that. You may not know what is that it contains. So the first step for you to check is find out what does this ETF really represents. Under the name of this ETF, what assets are included? Is that the asset you want to buy? Is that something what you are looking for, or is it something which is different there? So check what this ETF stands for, what are the assets which are built into it. The second point you have to look at is ETFs are traded on the stock exchanges, so you should have sufficient volume of activity or trading that happens in that an ETF. If you are stuck with an ETF and if there are no volumes on the stock markets, then you may not be able to sell them. So the liquidity becomes very, very important. The ETFs what you are going to buy should have good amount of volume. More the volume, the better. If you see lesser volumes on the traded quantities of this ETF, then there is a good chance that you may get stuck with that particular ETF and you may not be able to sell it. One another point that you have to consider is look at the cost or the expense ratio of this ETF. A similar ETF can be available from different providers. You can compare the expense ratio between different providers of similar ETFs and probably you can choose an ETF which has a lesser expense ratio. Likewise, there are dealing costs. Dealing cost is the cost of buying and selling. Many brokerages house may not charge you anything for buying and selling of an ETF, or the cost can be higher or lower. So when you are buying these on a platform or through a brokerage house, one another thing that you have to look at is what could be the dealing cost of these ETFs, and lesser the dealing cost, it is better for you. When you say you don't have a dealing cost, it doesn't mean that the ETFs do not have a cost with it. ETFs do have a cost, they have a due expense ratio like a mutual fund, but these are much lesser than the mutual funds. The lesser the cost, the better should be the principle which you should follow. Now you have three options in front of you: to buy the stocks, to buy the ETFs, or to buy mutual funds. All three are in the same sphere. What is better for you? Or is there an advantage ETF gives you over the stocks and the mutual funds? ETFs give you one advantage over a mutual fund. That is, the costs are much lesser than a mutual fund. Let's say if a mutual fund has a cost structure of 1 to 2% as an expense ratio, normally an ETF expense ratio will be in the range of 0.3 to 0.7%. That's way below the mutual fund cost. Internationally, the mutual funds may come to you in different shades. So there may be an entry fee along with that. There can be an intermediary fee along with that. So when you put all these things together at an international level, what we see is mutual funds are far expensive. Whereas in case of an India, mutual funds are still very competitive compared to the mutual funds which are available in the international markets. The disadvantage with a mutual fund is, as I said, is one, the cost structure is higher. Second thing is you have to buy a mutual fund at the closing NAV of the day. You can't buy at a dynamic pricing. If the markets are moving up by 2-3% per day and you can't choose a particular price to invest there, you have to wait for an NAV to get declared, and depending on the cutoff time, so you will get an NAV which is fixed by the mutual fund house. In case of an ETF, you can choose an appropriate time to buy and you can make best use of the market movements up or down to enter or to sell. There is one advantage over ETFs when it's compared to the stocks. When you talk about the stocks, when you buy a stock, it represents a risk. So you buy one single stock, anything could happen with that. But when you are buying an ETF, it's a pool of investment. There can be many stocks there, or it could be representing a index. So your diversification automatically happens when you buy an ETF. Whereas in case of a single stocks, it represents a huge risk for you. ETFs will also bring down the dealing cost. Now let's imagine that you have to buy 10 different stocks. So in case of buying these individual stocks, you have to provide a dealing cost for individual stocks. What if the same 10 stocks are bundled into an ETF and you buy it as a stock? So the cost of dealing or the cost of buying and selling on the exchange itself comes down. You don't have to buy 10 different stocks, as well as the cost of dealing itself in ETF itself is lesser in the brokerages or in the platform. So it reduces the dealing cost, it reduces your expense ratio, it helps you to diversify, and you get the benefit of dynamic pricing, and you can choose your time at the time of trading to buy these ETFs. So ETFs will score over stocks and the mutual fund in this respect. Stocks will represent only particular sectors, whereas ETFs can come to you from any sector. You can have a pooling of different things, different strategies. All these things it is possible to do under ETFs. So ETFs is gaining popularity for the simplicity, reduction in cost, and applicability in a financial planner's or an individual investor's portfolio. One another advantage with ETFs is in some of the countries these are more tax efficient than the mutual funds. Mutual funds own the stocks. When you buy and sell, it may involve certain types of taxation in some countries. Whereas in case of an ETF, they do not own these assets. Therefore, it is said that they are more tax efficient. I cannot say that it happens in every country, but in some of the countries, it is said that the ETFs are more tax efficient when it is compared to the mutual funds or the individual stocks. Apart from the ETFs, one another popular thing which is happening right now is the index funds. Is there a difference between an ETF and an index fund? The answer to this question is yes and no both. If the ETF what you are buying is based on an index, then the index fund and the ETF could be similar. Then where it is differing from an index fund? An index fund is a mutual fund. So you have to buy it at the closing NAV on any single day. Whereas in case of an ETF which is tracking the same index, the pricing will be dynamic and you can choose at what price you want to buy. You can choose at what point of time during the trading hours you want to buy this. That's where the difference comes in. Costing wise, I don't think there is a huge difference between the mutual fund, an index mutual fund, and the index tracking ETF. Cost difference may not be much. One difference which stands out is in case of an ETF, volumes become very, very important. Now, if you have picked up some ETFs from some index and if there is no liquidity on the stock exchange, you may get stuck with that ETF. You may not be able to sell because there is no buyer on the other side. Whereas if you have purchased an index fund from a mutual fund, you are under no fear that you will not be able to sell it, because the responsibility of selling the units belong to that of the mutual fund. You can any day sell this index fund back to the mutual fund house and you can collect your money. Whereas in case of an ETF which is tracking the same index, you should find a counterparty to buy the ETFs. Then only you will be able to sell it. If there is no liquidity in the ETF that you have chosen, there is a good chance that you may get stuck with that investment. Dear viewers, hope the video that I have done today on the subject of ETF helped you to understand the world of ETFs and why it makes relevant in your case to have a look at ETFs as something which you must have in your portfolio. If it helped you to understand the intricacies around ETF, please like this video. If you are a person who is watching this channel for the first time, or if you are yet to subscribe for this channel, please hit the subscribe button and press the bell icon. Don't forget to share this video with your friends and relatives. Thank you very much for watching this episode on NRI Money Clinic. I shall be back with you with yet another useful topic in yet another video very, very soon.
Press the bell icon for more details and subscribe our channel.